Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Sedan. This week we're covering the 5-year rule for Roth IRA contributions and payouts and which contributions start the 5-year period. We'll be covering Secure 2.0 Act changes going into effect in 2024 at Spidell's Federal Tax Update webinar on January 4th and 5th. You can see a full list of topics covered at this year-end update and get registered at spidell.com under webinars. Many taxpayers undertake Roth conversions to avoid taxes on future earnings when these amounts are withdrawn from the account. A Roth conversion is a movement of assets from a traditional SEP or simple IRA to a Roth IRA. Taxpayers recognize taxable income equal to the amount of the conversion, less any basis in the traditional SEP or simple IRA. Roth conversions are not subject to early withdrawal penalties. But there is one exception to the tax-free earnings benefit. Roth earnings are taxable if they're withdrawn within 5 years of the date the taxpayer first established a Roth IRA account. This is true even if the distribution occurs after the taxpayer reaches age 59 and a half or is disabled, if it's used by a first-time home buyer up to $10,000, or if it's made to the deceased taxpayer's heir or estate. The 5-year period to determine whether a distribution from a Roth is includable in income begins on the first day of the taxable year for which the first contribution is made to any Roth IRA. There is only one 5-year holding period requirement for all of an individual's Roth accounts. The requirement does not apply per account. There is an exception for a beneficiary who receives a Roth IRA after the owner's death. In this case, the holding period is not redetermined when the Roth owner dies. The Roth owner's holding period carries over to the beneficiary. Also, the holding period for an inherited Roth is determined independently from any of the beneficiary's own Roth accounts. A calendar year taxpayer can start the 5-year period by making a contribution anytime between January 1, year 1, and April 15th, year 2, and the start date will be January 1, year 1. So if a taxpayer made a contribution on April 15th for the previous tax year, the 5-year period begins on January 1, year 1, meaning the holding period actually is less than 5 years in this situation. If a taxpayer converts a regular IRA into an existing Roth IRA after the 5 tax year period has begun, this will not start a new 5-year period. The initial contribution to a Roth IRA does not start the 5 tax year period if the contribution is a corrective distribution, because a corrective distribution is treated as if it was never contributed. Also, an initial contribution does not start the 5-year period if the contribution is revoked within 7 days or recharacterized. For tax years beginning before January 1st, 2023, SEP and simple plans could not be designated as Roth accounts. Simple IRAs are authorized to accept Roth contributions beginning in 2023. SEP IRAs could be funded only with employer contributions and not on a Roth basis. The Secure 2.0 Act added a provision that allows SEP IRAs to be designated as Roth SEP IRAs beginning in 2023. Any employer contributions to a Roth SEP IRA are treated as taxable compensation to the employee. Contributions to a traditional SEP IRA are excluded from the employee's taxable compensation. For taxpayers who have never had a Roth account before, contributions to either a Roth Simple IRA or a Roth SEP IRA will start the 5-year holding period for the taxpayer. Spidell's upcoming live webinar topics include the centralized partnership audit rules, the new mandatory beneficial ownership requirements, understanding the business interest limitation, and more. For a full list, visit spidell.com and click webinars. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.